We've seen a rally in the markets generally on the consensus that pause that we saw from the Fed, that it was a bit of a dovish pause, or that the Fed may be pretty close to ending its rate hiking campaign. You heard the comments from those Fed officials. Has that narrative changed?
I think the Fed speak will continue to be vigilant. They're going to continue to talk about needing further progress on inflation. But I think what we're seeing here is that if we're not at the end, we're very close to the end. I happen to think we're at peak rates here. And we saw a preview, I think, of next year in last week's action with expectations for Fed futures coming down a bit and markets rallying. And I think that's going to be the key story for the next 12 months is what is the outlook for Fed funds and what does that mean for valuation?
All right, so you're talking about the Fed funds. I also want to talk to you about the bond market. So this, resurgence of hawkishness, if you will, from some Fed officials. We have to wait and see what we hear from Jay Powell today. How does that impact the bond market?
I think we'll probably settle in around these levels. So the outlook for a year out is around 4.5. We're around 4.5, a little higher on the 10-year right now. I think that's a pretty stable place to be for the time being. I think we'll continue to see how inflation unfolds, particularly with numbers next week. But I'd expect the Fed talk to be somewhat hawkish. They're going to keep an eye on this. They'd rather do too much than too little. We've had some progress with the move down in rates here as far as equity investors are concerned. And I think from here on out, the focus is going to be on just vigilant language from the Fed in monitoring inflation.
So, Robert, I want to talk to you about some new data. We're releasing a new CNBC Generation Lab poll called Money and Youth in the USA. It measures what 18 to 34-year-olds think about the economy a year out from the 2024 election. We asked whether the stock market is a good place to invest in and build wealth. More than 60% said yes. What's your take on that?
I think that's a good answer. Over time, we've seen the resilience of the U.S. economy. We've seen the ability of companies in the U.S. to grow earnings. And that's how wealth is created in this country, is great companies being created and producing wealth over generations. And so I think that's a good response from the youth of America.
All right. So you agree with the youth of America. I want to talk to you about where you're looking for opportunities in the market. Right now, it's consumer discretionary. Give me a sense. What do you see in there? Why is that the place to be right now in this environment?
Well, I think that's a sector that has three things going for it. The first is that revenues have been growing. And while they'll slow a little bit, the job market remains pretty strong. And so when you're putting more people to work, you have more money to spend on a discretionary basis. That's good for revenues in that sector. And then we've seen earnings growing as well. And that earnings growth, though, hasn't been just from the revenue side. So even if revenues slow a bit, margins have been very strong in this space. And I think the application of some of the technologies and robotics and things that we've seen in the past year and throughout the pandemic is going to help that sector in terms of margins in the year ahead.
All right, just for clarity, some of the top stocks in the consumer discretionary sector: Amazon, Tesla, Home Depot, McDonald's, Nike. Excuse me, as we enter the holiday season, any one of those in particular that you think has the best outlook when it comes to the consumer discretionary sector?
I'm just going to stick with the sector overall rather than any individual names, but I do think the sector continues to have a bit of a tailwind from the strong job market. I do think we'll see a pretty solid holiday season here this year, and that should give a boost to the sector as well.